Good evening, class, and welcome to our performance management class for today. Today, we are taking the first of the series of variance analysis. So, variance analysis is our focus for today. Now, we're going to be looking at standard costs, then we'll dive into introduction to variance analysis. We'll look at direct material variances, direct labor variances, variable production overhead variances, fixed production overhead variances, and if there is time, we can look at sales variances and interrelationship between variances. Then we'll look at reconciling budgeted and actual profits using the standard absorption costing. Then we'll look at the standard marginal costing, then productivity, efficiency, and capacity ratios. We hope we are going to take all of these. Otherwise, we'll break them down in segments for better understanding because this topic is a very important topic in your learning. Now, let's start. Looking at exam context here, this chapter explains the techniques of variance analysis. This chapter explains that a flexed budget shows what would have been achieved based on the actual level of activity, but assuming relevant per unit and all cost per unit have been the same as budgeted. It is a new budget drawn up for actual levels of unit sales and unit output. Then variance analysis reconciles the difference between the budgeted profit figure and the actually and that actually achieved. Then the reconciliation occurs in two steps. The difference between the original budgeted figure and the flexed budgeted figure is shown as a volume variance. The difference between the flexed budget and the actual result are shown in details. So this is a summary, or I would say an abstract of what this chapter or this segment is all about. We'll be able to explain standard costing. We are going to construct a flexed budget and calculate volume variance. Then we'll also calculate, analyze, and interpret various variances related to material, labor, and factory overhead. Then we'll prepare reconciliation budgets to actual of budgeted profit to actual profit using the total assumption costing and the marginal costing. So all of these will stand to get here. This chapter might be split into two. All right, so let's go. Standard costing. What is standard cost? Now, standard units of product or service. Standard costing is involving the use of expected costs, which is called standard costs, as a substitute for actual costs in accounting system. So we use a standard cost instead of an actual cost. You want to plan. When you want to plan, you don't use actual cost, so to speak, because you may say this is an actual cost now, but when you get to the market, the cost may change. So we usually use a standard cost. Then periodically, we now compare the standard cost we have used in our accounting system and the actual cost incurred in order to know what the variances are. So it means that you are planning your expenses for the next week, maybe as at Friday today at work, you are planning your budget for the next week, and you now use standard cost. When you now go to the market, you find out that the cost may be higher or lower than what you planned. When is standard cost inappropriate? It is most useful when we are counting for homogeneous goods that are produced in large numbers. When they say homogeneous goods, this is similar goods. Example is bread. Let's say you have a particular brand of bread, that particular size, that particular flavor, you are producing it for a large quantity. So you want to know what is the standard cost to produce this bread. So that's when standard costing is going to be used. And so in our example, we might be using bread and cake. Standard costing system may be used when an entity produces standard units of product or services that are identical to other similar products. All right? So it means that the standard unit has exactly the same input resources as all other similar units. So it means the same direct materials, the same direct labor is being used. Standard cost. This is an estimated or predetermined cost of performing an operation or producing a good or service under a normal circumstance or condition. Now, when we are using standard cost, this is the cost for 1 unit of goods or 1 unit of service. So it's as good as saying standard price. That's for selling it. But when you are making it, you say standard cost. So if someone say, what's the standard cost for making bread? It means, what does it cost you to make 1 loaf of bread under normal condition? Standard costing is a control technique that reports variances by comparing actual costs to this predetermined standard cost. All right? So it means that standard costs are predetermined. Remember when we are doing absorption costing and we say overhead absorption rate? That's a kind of standard cost because that rate is predetermined. So now we are looking at standard cost is a predetermined unit cost, just one. So I want you to look at this difference now. Standard is the building block of budget. So when we say budgeted cost, it means we have used a standard cost to make plans for more than 1 unit. So it means if I say I want to budget for 10 students for loaf of bread, so you see I've used the word budget. I want to budget for a set of 10 students. That means I'm going to use a predetermined cost, standard cost, and just multiply by volume. So budgeted cost is built from standard. I want you to bear that in mind as we move along. Now, a standard cost is a predetermined unit cost based on expected direct material quantities and expected direct labor time, and price at a determined rate per unit of direct material and per direct labor. This is still talking about the overhead absorption costing. So standard costs of product are usually restricted to production costs only. Standard costs are restricted to production, never administration and selling costs. Overheads are normally absorbed into standard cost at an absorption rate per direct labor hours. So this is the overhead absorption rate I was telling you about. Now look at this example here. This is a standard cost card. So it means that if you want to make bread, maybe you are just new into the company and you want to join in this business, and you are now the factory manager. All you just need to do is to ask for the standard cost card. And let's say this is product XYZ, which is bread XYZ. Look at the direct material. Material A could be flour. It takes 2 liters of material A to make one loaf of bread, right? And 1 liter of material A cost us 4 naira 50 kobo. So if you must use 2 liters, it means 2 times 4.5 makes 9 naira to make 1 unit of bread. So material A, the cost of material A for 1 unit is 9 naira. The same thing with material B. We need 3 kilos to make a loaf of bread. And 1 kilo is 4 naira. So that means for 1 loaf of bread is 12 kilo. When you add material A and material B, 9 plus 12, it gives you 21. So this is the total cost of materials for 1 loaf of bread. Then we go to direct labor. We need maybe grade 1, maybe the semi-skilled laborer. They will spend 0.5 hours making 1 loaf of bread. And we usually pay 20 naira per hour. And since this is half an hour, it means they're going to take 10 naira for that 1 loaf of bread. And now we go to grade 2 labor. Maybe these are skilled laborers, or maybe unskilled labor. Unskilled labor, you pay them 16 naira per hour, and they spend 0.75 hours. You end up paying them 12 naira for 1 loaf of bread. So when you add the skilled and unskilled of grade 1 and grade 2, labor hours is 22. Okay? Labor hours is 22. We have material up here. We have labor. Then we get to production overheads. So what do we usually say? Production overheads is usually based on direct labor. And so when you bring your direct labor, this is 0.5, 0.5 for grade 1 plus 0.75 for grade 2. That is what we have, this 1.25. So it means that variable overhead is the total direct labor hours is what is also applicable to variable overhead, because variable production overhead will go with labor hours. And now we are pricing it, we are paying it. This is the overhead absorption rate for it, or variable production overhead per hour is this variable production overhead per hour 4 naira. So when you use 0.1.25 hours to make 1 loaf of bread, because of grade 1 and grade 2, you are paying 5 naira. It is this fixed cost. If you look at it, the labor hours is 1.25, and overhead absorption rate normally use labor hours. So this is the labor hours. This is the predetermined fixed cost that we are using, which is overhead absorption rate multiplied by the number of hours, you get 50. And when you add material, labor, production, variable overhead, and fixed overhead, you get standard cost for 1 unit. So in the exam, you may be seeing this standard cost, and they might give you a profit margin. Assuming they give you a profit margin of say 20% or markup, they might give you a cost markup of 20%. They might add that 20% to 98. You find 20% of 98, that's a markup. You add it, you have your standard price. So you might be seeing something like that. But this is a cost card, so that is why it's ending at standard cost for 1 unit. Okay, so how did they get all these costs? That's a controlled environment. They may have done maybe 100 units and they control the whole thing, and they found out that this is the whole, maybe they put a whole bag of flour and it gave out 100 units of bread. So they now look at it. If one bag gives us 100 loaves, how many kilo, maybe they have measured it, how many kilos or liters would have given us, how much would it, how, if we spend this amount of um we spend this amount of naira in one bag, maybe the bag is 50 kilos and a bread is 1 kilo, 1 kilo, 1 kilo. That means you have 50 loaves of bread. That is the 50 kilo. That's the way they will now, from the whole, they are now going back from plenty that you've produced, they now break it down to a singular unit. So that is how they will have created the budget to know how many liters material A for 1 unit will be. They have done a controlled production to get this. So standards, who sets them? Standards are usually set by managers with expertise to assess what standard prices, I told you about standard prices and rates should be. And these are normally reviewed typically when they want to make a budget. Standard prices for direct materials, who set it? It is the purchasing manager, because this is going to be the purchasing department. So it means in the production we have the purchasing manager who is going to be the one to buy those materials. And so he knows what are the prices. So all these prices that we are seeing, this particular price here per liter, per kilo, it is done by the purchasing manager. Okay, then this one here is done by the production manager because he knows that 2 liters is going to be used to make 1 loaf of bread. He gets this 4 naira 50 kobo from the purchasing manager, simply multiplies by 2, he gets 9 naira. So all of this cost here is normally done, these particular ones here are normally done by the production manager because he's the one in charge of production. But the purchasing manager gives this, right? Now, the standard rates for direct labor is set by the human resource department. So this particular 20 naira and this 16 naira is usually set by the human resource department. So the production manager will just simply multiply by the number of hours required to get the final one for the loaf of bread. Now, standard usage rates for direct materials and standard efficiency rates for direct labor should be set by managers in the operational activity. So that's the operations manager. The operations manager will set the standard usage rate. That's the hours, the liters. He sets this. So he sets this, the operations manager. Sometimes the operations manager may also be the production manager. Then the standard overhead rates is set by the accountant, management accountant. So this overhead absorption rate, that is what is gotten by. So this one here, this 40 naira is gotten by the budgeted or the accountant after doing this overhead absorption rate. All right, so we have seen all the people who brings all this to the table. So standard costing, we said, is a system in which all units of products or services are recorded in the cost account at their standard cost. And the value of inventory is based on standard production costs. Differences between actual and standard costs are recorded as variances, and variances are reported at intervals. All right. Standard costing has four main uses. One of them um, is an alternative system of cost accounting. It can also be used to prepare budgets. I told you budget is simply just multiplying a standard cost by the um, number of level of activity you plan to make. Also, it is used to as a system of performance measurement. This is where we are interested, as a system of performance measurement. That is where variances comes in. So the difference between the standard cost, which is what we call expected cost. When you go to the market with a particular amount of money, of course, it's a budgeted cost, expected cost. You are not going to go and buy one loaf of bread. Maybe you want to buy like three, four, five. So you have used standard to measure the budgeted. That's expected cost. The difference between the expected cost and what you actually meet on ground shows the performance measurement. It's also a system of control report. Also, what we're also interested to when differences between this actual and expected. So you see here budgeting and standard costs, they should be reported so that management can identify how whether to control some of these things that are bringing poor performance, how they can control it, how they can reduce wastage, or what they can do to um, stem the tide of adverse variances. We'll come to that. When there are large adverse variances, when we say adverse variances, it means this like a negative variance. Okay, so how will I explain it now? When you go to the market with 20,000 naira, maybe to buy shoe, and you go to the market is saying the shoe now costs 22,000 naira. It means it is an adverse variance because the actual cost, what you spent on buying that shoe, is higher than what you carried to the market. It means your cost has increased from expected. But when it is favorable, it means your planning is 20,000 naira and you went there, it is 19,000. You spend less than what you planned. It's favorable for you because you now have like extra money with you. So when there are large adverse variance, this might indicate that performance is poor and they will need to take control action when there are large variances. It could be that the prices too are also high. It will also indicate that performances is poor we'll come to see that when there are large favorable variances, so it means instead of paying for the shoe 20,000 and they are asked to pay 15 or maybe 12, management should investigate to find out why this has happened and whether any action is needed to ensure that the favorable results will continue in the future. Sometimes when we see a favorable variance, it's not always a good thing that you have a very large favorable variance. It could also mean something bad, as we'll see. But sometimes, if it is not large, you may want to ensure that you continue in that favorable variance in the future. Now, let's go to deriving standard costs. A standard variable cost of a product is established by building up the standard material, labor, and production overhead for each standard unit. In a standard absorption costing system, the standard fixed overhead cost is a standard cost per unit. Standard fixed overhead cost is a standard cost per unit based on budgeted data about fixed costs and the budgeted production volume. What I mean is this. Okay, so I'm using Zoom now, and Zoom is an overhead cost, and Zoom has 100 participants. Let's assume it's 100 participants, and let's say I spent 50,000 naira per month. That's an assumption. Or let me just not go too far. Let's say I spend 20,000 naira per month. All I simply need to do is I will simply say 20,000 naira, which is the maximum cost I spend for 100 participants, divided by 100. It means for every participant, I am spending 200 naira per participant in fixed cost. So it doesn't matter whether I have one student, five students, nine students, that fixed cost per unit is what I'm going to be using. Companies can often measure standard quantities with a high degree of confidence. Remember that standard costing appropriate is appropriate in condition of high production numbers and lots of repetition. So that's what we usually rely on standard costing for. So standard usage of material. This is derived by obtaining historical record for material usage in the past, and then the design specification for the product. Most of these things here will not be asked of you, so let's skip them now. Let's look at deriving a standard cost here. Now let's see. A company manufactures two products, X and Y. I'll call it bread and cake in year one. Now in year one, it budgets to make 200 units of product X, I'll call it bread, and 1,000 units of product Y, I'll call it cake. Now, see, because now they said this is not one unit, it's more than one. You see the word, it's budgets. You can never say standard when it is more than one. So when it's more than one, you say budget, and here we now say budgeted resources per unit. Okay, budgeted resources per unit. Now, per unit now is now standard. Direct materials per unit, that's the standard now. We budget to use 2 units of material A to make one standard product, one standard unit of product X, and we budget to use 1.5 units of material Y to make one standard unit of sorry, 1.5 units of material A to make one standard product of Y. Then material B, 1 unit of material B to make 1 unit of X, 3 units of material B to make 1 unit of product Y. Direct labor hours. We plan to spend 0.75 hours to make product X, yeah, 1 hour. Then the other cost here, we have direct material. So this is direct material. This is usage. These up ones here are usage, direct material usage. Who sets material usage? We said it is the operational manager. This is the purchasing manager, rather. No, operational managers. Then direct material cost. Direct material cost is 40 naira per unit. Okay, so it means material A, 1 unit of material A is being purchased at 40 naira. So says the purchasing manager. So what it means here is that if you are going to use 2 units, it means this is going to be 40 times 2, that's 80. Here is going to be 40 times 1.5. Material B production purchasing manager is giving us 30 naira. Labor, HRO is telling us 200 naira per hour. Variable overhead, okay, so operations manager is telling us this. Fixed overhead are calculated by applying a direct labor hour absorption rate to the standard labor hours per unit. This is done by the accountant, as we said, using the budgeted fixed production overhead cost of 120,000 for the year. It's just like saying I'm paying 20,000 naira for Zoom every month and I want to do it times 12 months, it's going to be 240. So obviously, it's like saying this is 10,000 naira per year per month. Do it for 1 year, this is 120. That's fine. We are required to calculate the standard full production cost per unit of X and Y. So let me make a second instance of this so that we will see, we'll be referencing it as we go. Okay, so let me create a second instance of this so I can go straight to solution. Just a moment. So now this, let's go to solution here. Now we are told here that material, okay, this, let's calculate the budgeted overhead absorption rate first. That's what is done first. Product X, 2,000 units. Where did we get that? 2,000 units is being done here. That's fine. Now we need 7.5 hours, 0.75 hours. So direct labor hours per unit. So it means for 1 unit, you need 0.75 hours. Then when you have 2,000 hours, it means you are multiplying it. It means this is the number of hours, 1,500 hours. That is what you are going to use to make product X. Then when you do for product Y, you need 1,000 units of product Y, 1 hour for each product, meaning you have 1,000 hours to produce. So when you add that of product X and product Y, you have 2,500 hours of direct labor hours for the two products. All right, so this is the number of hours. Then we are told that this is the production overhead cost for the year, 120,000. So if you have 120,000, so all we simply do here, overhead absorption rate is total overhead cost, 120,000, divided by number of hours, 2,500. And that gives us 48. So your fixed overhead absorption rate here is 48. That's how we get our 48, which was not given to us. All these ones were given to us per direct labor, per this, per that. But this one, fixed overhead, we were not told what is the overhead absorption rate. So because we need to find standard cost, we need to know fixed overhead per unit, how per hour. So this is per hour. All right. So what it means now is this is product X, this is product Y. All these here are per unit. So direct materials, we will need 2 units to make 2 units of A to make 1 unit of X. 1 unit of X costs 40 naira. So 40 times 2 will give me 80. And the same thing with Y for material X, 1.5 times same 40 naira, that is the cost for X for A. That is how much the purchasing manager is telling us he's buying material A. So this one is 80 naira, this one is 60. Going to material B, we are using 1 unit as, and here we're using 3 units. The cost is 30. 1 unit times 30, 3 units times 30, that gives me 30, and this gives me 90. Direct labor, this is using 0.5, 0.75, rather, this is 1 hour, and the cost is 200. So 0.75 times 200, 1 hour times 200, so this is 150, this is 200. Variable overhead, we have 40 naira per direct labor hours. So you still do the same thing because this is the direct labor hours here. 0.75 times now 40, that's give me 30. 1 hour times 40, that's give me 40. When you add material A, material B, direct labor, variable overhead, this will give me 290 here, this 390. This is standard variable production cost because material and labor are all variable costs, and this is variable cost. So all of this 290 is standard variable cost. Normally we said your full cost is made up of variable cost and your fixed cost. Now this is variable cost. We need to know our fixed cost. We have gotten our overhead absorption rate per hour, and we use it to multiply the number of hours, use it to multiply the number of hours. So this is 36, this is 48. When you add your variable cost with your fixed cost, you have your standard full production cost as we have gotten so far. So you see why we have to do our fixed overhead absorption rate first, because we can do all of these rates easily. But here we don't do. Even though you didn't start with this, when you are coming down to here, you can always go and give a workings and come back and fix the figure. So that's what this question is telling us here. They fixed the full production. So because we see full production cost, that is why we are calculating variable cost, we are calculating fixed cost. And because they use the word standard, we are calculating it, you see it is per unit. So normally if they have given us number of units and maybe they use budgeted costs, you need to divide by volume to get standard cost. All right, so now let's look at practice question. Practice question. A company makes two products, L and H. In year one, it budgets to make 6,000 units of product L and 2,000 units of product H. Budgeted resources per unit and cost are as follows. And look at the materials, look at their materials, labor hours, then we have their costs. Fixed overhead absorption rates are calculated by applying a direct labor hour absorption rate per unit using the budgeted production overhead costs of this for the year. Calculate the full production cost per unit of product L and H. So let's do this now. Let's do this just to try our hands. Let's try our hands now. This is performance management. So this is variance analysis part 1. So we are on standard cost, standard costing. All right, so this is practice question 1. And that's on page 226. I will say 226, 217, whichever. I will say 226, 217, whichever. All right. If you're using the soft copy, it is 226 here. If you're using hard copy, it is 217. That's what I mean. Now, the company budgeted manufactures two products, L and H. So we are asked now to find the standard full production cost per unit of L and H. So sorry, we are going to do it here. Standard full production cost per unit. This is what we are looking for. So this is what are the products? L and H. So this is products. So this is L and this is H. So this is L and this is H. So I can come here, put this here, and put this here. Then I will say the first one is material X. So I will say material X. So what is all about material X? This is 3 kg, 1 kg. All right. How much did we buy it? So I can come here and say, open a bracket, 30 naira multiply by this 3 kg, this is 1 kg. 3 kg is to 1 kg. Now, when you do it like this, what it means here is this 30 multiply by 3, this 30 multiply by 1. So that's 90, 90 naira here. That's 30 naira here. That's for material X. We go now to material Y. Now say this is material Y. Open a bracket. How much did we buy Y? 40 naira. Now say this is 40 naira. Multiply by, what is the usage for one? 2 kg, 6 kg. This is 2 kg, 6 kg. 40 times 2 give me 80. 40 times 4, 6 times 4 is 24. That's 240. All right, so we've done Y. The next one is done X and Y. Then direct labor. Direct labor. So you come here. direct labor. Now, what is the cost for direct labor? 250 per hour. So this is 250 hour multiplied by how many hours was used here? 1.6 is 3. 1.6 and 3. 1.63. The 1.6 hours. Let me put hours here. 1.6 hours is to 3 hours. So we activate our calculator now. 250 times 1.6. That will give me 400 here. So that's 400. 250 times 3 is 750. All right, so direct labor is done. Now we have variable overhead. Variable overhead is 50 naira. So you come here, variable overhead, we have it as 50 naira. It will be multiplied by 1.6 hours to 3 hours. So we do the first one. 50 multiplied by 1.6. That gives me 80. Here will give me 150. Okay, so when that is done, we now go to this is all the variable overheads here. We now add them together. So what do we get here when we add them together? We have 90 plus 80 plus 400 plus 80. That gives me 650 here. This is 650. So this is standard variable cost per unit. 650 is here. Then this is 30 plus 240 plus 750 plus 150. You have 1,170. 1,170. Then you now go down to the fixed costs, standard fixed cost per unit, and open a bracket. We don't know the overhead absorption rate yet, so we are multiplying it by 1.6 hours is to 3 hours. We don't know it, so we go down and do our workings. Meanwhile, when you get that, put it down here. This is your standard full cost per unit. So you will now go and do your workings. So I will say this is workings, overhead absorption rate for fixed costs. So what you do now is, what is the um, total fixed cost here? 1,800,000. So we have 1,800,000. All right. We are going to be dividing this by the total hours that we are going to do. We are going to use here the first one is 1.6 hours for product X, and we are going to be making, okay, product L, we are going to be making 6,000 of it. So you multiply by 6,000, then plus we have 3 hours multiplied by 2,000 units. 2,000 units. So this will now be like 1,800,000 divided by, this will now be 1.6 times 6,000. That will give me 9,600 here. This is 9,600 plus 3 times 2 is 6,000. Okay, so this is as good as saying 1,800,000 divided by, now we have 9,600,000. If you add 6,000 to it, to give me 15,600,000. No, 15,600. 15,600 hours. So when you do that, I can as well copy this. All right, so I'll start 1,800,000 divided by, I will now paste what I've copied. 15,600,000 gives me 115. So this is approximately 115.3, 115.38. Let me say 115.38. 115.38. So I can go here and say 115.38. I will not remove what is in my calculator. I will not remove what is in my calculator. I can as well multiply, I can as well take it from here and use it here. Okay, so I have, the first one is this cost multiplied by 1.6. So I can start with 1.6, 1.6 multiplied by this very cost here, even though I've written the round figure, and it gives me, I will call it 185 to the nearest whole number. That's 185 here. I take it as 180, 185. Then I will come here. This is this same cost here. I'll have it here multiplied by 3. That should give me 346. So yeah, this will give me 346. So now I have, so I have what's happening? I have 650 plus 185. That gives me 835. 835. And so I have here 1170 plus 346. That gives me 1516. 1516. And that's what we have as our full cost per unit for this question. So that's it. Now we go to type of standards. There are different kinds of standards that are predetermined. We're talking about four types. We have ideal standard. So sometimes you hear people say, in an ideal world, in an ideal system, this is a system that assumes perfect operating condition. So when we say in an ideal system, there is no allowance for wastage. It means you are using your resources very efficiently. There is no machine breakdown, no idle time. If you are coming to work, you are coming to work. You're not sitting down to press your phone or to chat. There's no inefficiency. So this is an ideal work. So you say in an ideal work situation, you won't be finding anybody sleeping. You won't be finding people just lazing around. When you ask them, they say machine has broken down, or you will find waste. So you want to make bread, you won't be finding burnt bread. You'll be finding bread that is over rice, or you find bread that is half done. Everything is working well. Then you will now look at it to get the standards in an ideal situation. Sometimes in practice, the ideal standard is not achieved because you will not have an ideal situation. Now, attainable standards, we assume that they are efficient, yes, but they are not perfect. That means you will have an allowance for waste. So that's why sometimes we call normal waste, not abnormal now, normal waste. So it means that it's just like saying you want to make clothes and you buy some materials. You will not use every material to make clothes. There must be some waste. So you want to you want to make a product, you allow for a normal waste. Okay? Then a normal inefficiency, machine breakdown, like sometimes too, I allow for network problem in my class, network um, internet issues to start. That's why normally we usually give an allowance of saying 3 hours in class. But sometimes the normal standard time, if everything, the ideal standard is to have 2 hours. But because we want to make some allowance for inefficiencies, say, okay, from 8 o'clock to 11, instead of from 8 to 10 most times, which is the normal thing, or from 9 to 11. These are attainable standards so that we know waste is inevitable. Now, current standard are based on current working conditions and what the entity is capable of achieving at the moment. Now, even though you have given attainable standard, you may not achieve it. Of course, attainable standard are supposed to be achievable, but you may not be able to achieve it. And so, what is the current standard that you are using now? That is the current standard. Then, basic standard, these are basic, they remain so for a long time. For example, those things that you've been calculating in that your standard cost card, all of these are basic standard. It means that you use this amount of material X, this amount of material Y. These are basic. Then you want to the costs also might be basic, but sometimes inflation, currency exchange, and other things might affect. But these basic standards are expected to remain for a long time. So these are the four types of standards we'll be talking about in the exam. Now, standards need to be reviewed. How often should standard be reviewed? Should it be reviewed every year? Should it be reviewed periodically? How periodical? For example, wage or labor rate. How often should you review labor rates? Especially you know that You are going to be giving them incentive schemes. How often should you review your labor? In standards, in practice, standards are normally reviewed annually. So sometimes standards are reviewed annually because sometimes standards seem to be obsolete, and so we need to review it annually to see whether it is still meeting up with the current realities. So standards are usually reviewed annually, but sometimes standards take a long time to be reviewed. For example, look at our tax laws. Our tax laws are like tax standards, isn't it? Our tax rates, how much is VAT rate? These are standard rates, right? How much is current income tax? These are standard rates. We don't review them every year, okay? We review them over the time. That's why we have a presidential committee that are reviewing taxes, because the standards have is no longer fit it's no longer fit for purpose, and so it needs to be reviewed. All right. So we see that standards can be reviewed regularly, be 1 year, to be at any time that it needs to be reviewed. So now let's go to the second phase, which is where we will wrap up for today. The second phase, which is introduction to variance analysis. Now, if you notice here, I don't want to rush you into this topic. I don't want to rush it. And so I want you to pay close attention, because people, many people usually fail this topic. And this topic is a topic that, if you know the rudiments of it, and if you follow me the way I will show you, this is one of the topic you can pass easily. Standard cost. We have said standard cost is for 1 unit. These are costs constructed by estimating the quantities of standard amounts of inputs into making a unit. And we've seen a standard cost card, right? So we have direct materials, direct labor, variable overhead. When you add them together, you get your marginal production cost, which we also call variable production cost. Okay, this is variable production cost per unit, of course. Then we have fixed overhead, which we know that this 600 naira is overhead absorption rate. We know all that, and this is the total absorption cost. Of course, when you say absorption cost, you know it's full cost. So that is the standard cost card. So you will always be given your standard cost card in your exam. So watch out for your standard cost card. You are not the one to set the standard cost card in the exam, you will be given to you. Now, I want you to look at this Lagos Manufacturing Limited. We are going to be using it to do an example. The example we are going to take here in our lectures will be based on this, so that we will understand when we are solving past questions, you will understand the rudiments. But first, let's look at this again. Just a moment. All right. This is the standard cost here. Everything you see here is standards. These are used in building the budget. Standard usage is 5 kg direct materials. Standard hours is 4 hours. labor hours. And know this, once you have achieved labor hours, that is the same amount of hours you use in variable overhead and in fixed overhead. Now, this is because this is efficient. Labor hours, you cannot spend variable overhead when there is no labor hours. So this labor variable overhead is spent as a result of work being done in that hours. Fixed overhead is usually being attributed to hours when we are using absorption costing. Direct labor hours is what we usually use. We don't use ABC in this. So we are using the fixed overhead, which is attributable to labor hours. So all these are standard usage. Now, these are standard prices or costs per kg, per kg, per kg. These are standard costs of inputs. These are standard material. These are standard inputs. These are the standard cost in the inputs. So this is the standard cost of the output. All right. We are going to be using this, so I'm going to go and get a second instance of this. Page 259. Get second 229. All right, so let's go there. I will keep this one here and I'll use this. No, they are both will be used throughout. Now, standard costs link to the budget through activity level. So I said it before. Standards linked to budget through activities. For example, the company wants to make 1,200 units. So it means that it will just simply calculate how much. If you want to calculate it, you just calculate material cost will just be 5,000 multiplied by 1,200, and that's your budget. So we said before, standard is for 1 unit. Take note of that. It's very important. Standard is for 1 unit. Now, if they don't give you your standard cost card, they are going to give you budgets. And when they give you budgets and they give you volume of activity, simply divide each of the budgets by the volume to get your standard. All right, so now Lagos Manufacturing Limited has budgeted to make 1,200 units, like we said. Now, what will the material cost be? 1,200 units multiplied by the unit standard cost, that's 6,000. Labor will still be the same thing, 1,200 units all through, multiplied by 2,000. All of these will be multiplied. Now, fixed overhead, we are using the same 1,200. All right. Now, this is fixed budget for the period. Now, what is a fixed budget? Let's look at it now. A fixed budget is the original budget that is prepared at the beginning of the budget period. So, whenever you are planning and you say, okay, I remember a particular time when I was working with a company and it was close to the end of the year. The board, the management sat down and said, okay, we want to make a budget for the next year. We want to make 1 million units of sales for the next year. 1 million units of sales. That is the budgeted quantity. So that it now give rise to a lot of things. How much will be spent on purchase? What are the likely prices? And prices are not being controlled by us. It is being handed down to us as some prices are handed to us as guidelines and all that. But at the end, we made a fixed budget. That is what we have at the beginning of our mind, that in the next year we are budgeting to make 1 million units. And you now go and divide 1 million, we divide it by 12 to know how much it's going to be per month. Sometimes we want to make it much more efficient. We just divide it by 52 weeks and we know how much we are productivity is going to be done weekly because performance is being appraised weekly. So a fixed budget is a budget for a specific volume of output and sales activity, and it is the master plan for the financial year that the company tries to achieve, like the example I told you. Now, for example, the Lagos Manufacturing Limited has budgeted, that's a fixed budget, to make 1,000 units, no, 1,200 units. That is what they have budgeted to make, produce. And they have budgeted to sell 1,000 units. What it means is that out of the 1,002 is going to make, it will sell 1,000 units. Okay, so we are going to be making another assumption. We don't know whether there's going to be opening stock, but of course we know there's going to be a closing stock of at least 200. All right, but let's leave that apart. We have 1,000 units to produce, 1,000 to sell. Now, from the budget setting, we've seen that the selling price is budgeted to be 15,000. You remember when we learned target costing, right? We start with selling price. We now look at it. You cannot sell more than that. It's just like saying you are in a controlled environment whereby if you sell, maybe you are producing alcoholic beverages and you're in a competitive market and you can't sell above a particular amount. Otherwise, people will go for your competition. So you have a target selling price. So that's like this now. You have budgeted to sell it at 15,000 per unit. Now, the standard cost of production are given as in the previous example, like we said. Look at the units that we are going to sell. This is the unit produced. So we're going to be doing something now. For every unit you sell, you are selling at 15,000, right? So it means that 15,000 naira times 1,000. Of course, there's three zeros up here. There's three zeros up here. So this is like 15 million, right? Now, cost of sales. Now, remember, I want you to look at something now. Your sales is 1,000 units, right? Cost of sales. What is cost of sales? It means what does it cost you to make this sale of 1,000 units? What does it cost you to make that sale of 1,000 units you sold? Of course, you produced 1,200 units, isn't it? But you didn't sell all of them. But take note, 1,200 units was produced, and we said is produced 5,000 naira material. So that's it. That gives you 6,000. Labor is 2,000 here. So 2,000 multiplied by 1,002, that's 24. Variable overhead, we said is 800. That gives us 960. Fixed overhead, we said was 24. So that's 24 per unit. Now, if you see here, we've converted the resources to per unit. And now we are using per unit now. That's what we are using now because this per unit. So now what happens is this. For you to make 1,200 units for the year, these are the things that it cost you. So it cost you 12,240,000 for the year to make 1,200 units. But of course, you didn't sell the whole 1,200 units. You sold 200. That is why you are minusing that 200 from this one too as a closing stock so that it will become 1,000 units. So how do we get it now? This is the 200 units that is not sold multiplied by 10,200. Now, where did this 10,200 come from? Okay, now this is what we are going to do now. This is where it came from. Now, 10,200. Now, can you see this 12,240? 12,240. This is the cost, right? Now, that is the whole cost for making 1,200 units. So you see, when you divide this, the total cost of making 1,200 units, you divide it by the 1,200. That means these are standard costs that you used here. The standard cost, because this is budget now, right? The standard cost of making this is like 10,200 per unit. That is what it means. So it means that your closing inventory will be based on your standard cost. Closing inventory will be based on your standard cost. So if it costs you standard cost 1,002, another way of doing all of this is that all you would have just done is you would have added this 5,000 plus 2,000 plus 800 plus 24. Of course, we have this 10,200. That's the 10,200 we got here. So this is the standard cost that we are saying here. It is all of this standard cost for one unit. That is what we also use here. Multiplied by the 200 units, you have 2,040. So this is what you are going to remove from 12,002. So when you remove it now, it becomes 10,200,000. Don't look at it that it is 10,200 though. This is 10,200,000. So when you remove, so this is your cost of sales. So this is your sales of 1,000 units. This is what it costs you to make this sale of. So this is what it cost you to produce the 1,000 unit that you sold. So when you remove it from 15 million, you're having 4,800,000 as your profit. Another way of doing this is that you just simply come here, okay? You simply say, you can just take this 15 minus this, where you have, okay, 15 million, or you can say this 15,000 here, sorry, minus 10,200, because 10,200 is this cost. You minus it from the sales. Anything you have, you multiply it by 1,000. That's it. So your cost minus sales is your profit. So your selling price minus your cost of sales price multiplied by the budgeted amount of sales you make, that's your profit. So that's it. So one of the main purpose budget budgeting is budgetary control and the control of cost. So you make a budget and it's going to help you to control your costs. It will resist you to make you to resist impulse buying. You you will be knowing when you are buying things in the market, you will know that okay, you don't want to exceed this cost. Okay, there was a time I went to the supermarket with a particular amount of sorry. a particular amount of money in mind, and I have my phone. As I'm putting things in my shopping cart, I'm adding the prices. I'm putting things, I'm adding the prices. Putting things, I'm adding the prices. When it gets to a point where I have seen that the next item is going to be more than what I have purchased, and I looked at it, I'm still having more things to buy. And I critically look at the items. Which one can I do without now? As I replaced it, I remove it from my calculator. I put one, I add, I remove this. So there are certain things that are not essential at the moment. Maybe I have a little of them remaining, and I can say, okay, I can manage. So at the end, I was able to buy just what I need that I cannot do without. So that's a way of controlling your costs. So when you have a budget, you have a list. Sometimes when I was small, we want to go to the market, our parents will give us a list. Buy what is in this list. So don't go and say, oh, I didn't know that we have it in the house. Or I forgot to buy this. So you don't go and buy more of what you have and then forget to buy the essential thing that you are supposed to. It controls the cost. The differences between the expected result and the actual result are known as variances. And variances could be favorable, which we'll call it F, or adverse, depending on the result achieved, whether they are better than expected or worse than expected. And now, how do we know that something is better than expected? It means that if I'm looking at cost, now take note, if I'm looking at cost, so let me put it down here. If I'm looking at costs, if my expected is greater than my actual, is equals to cost savings, which is favorable. So I have 10,000 in my hand, and I go to the market and I bought it 9,500. So my expected is greater than the actual, and it is cost savings, is favorable. So, but when expected is less than actual, it is deficit, and that's adverse. So in our variance analysis formula, you'll be seeing expected first, actual second, because we'll normally have an expectation in mind before we now get the actual. You will normally create a budget in your organization before the actualization of the budgeted activity. So our formula will contain expected first, actual. Now for sales, if expected is greater than actual, um is adverse. If expected is greater than, is opposite of cost. Now it means that I am expecting to sell something 15,000 naira, and I now go and sell it at 14,500. My expected is bigger than your actual. It's adverse. So in sales, your expected is supposed to be lesser than actual to get favorable. So all you just need to do is know about cost variance flip it the opposite side for sales in your mind, then you are in line. So there is no generally acceptable that this is the way you must write your formula. But how will you know a favorable and an adverse variance? You are looking at cost, expected is bigger than actual, that's favorable. For sales, the expected is bigger than actual, that's adverse. So let's put that in mind. Now let's consider the following. Now we are saying that we have made our budget, right? Now, because we've made a budget for January, maybe we made that budget in December. But at the end of January, that is when you will be getting actuals. Maybe this is February 1 now. You're now looking back at the actual results in January. You found out that instead of selling 1,000 units, you actually sold 900, right? Now, instead of producing 1,200 units, you produce 1,000 units. Now, what does this tell me? It tells me that your closing stock in actual is 100 and we are budgeting 200, right? All right, so let's look at the budgeted now and we'll compare it with actual. Look at our sales for budgeted here. It's 15,000. But actual, we are now selling it at 12,600. What does that mean? 12,000, 12,600,000, right? And now we sold how many? 900. If I divide it by 900, it means that we sold it for 14,000 as against, let me take this one here, as against 15,000 selling price. That is what it means. We sold it for 14,000 per unit. And that's why we got this. Then these are our costs. Material, labor, we got this, right? These are variable overhead and fixed overhead and all that. So now, if you look at this is your cost. So let me see here. I have 10,174,000 and now divided by 1,000 that was actually produced. And this is like my cost, actual cost. This is the actual production cost now, right? That's fine. Now, if this is my actual production cost, now look at closing inventory. Remember here, closing inventory the other time, we used 2004 because 10,200 times 200 units. Now, if you look at it, 2040. Now, if this is my standard cost for 1 unit, when I multiply this is standard cost for 1 unit. When I multiply this by 100, I should be getting this. Of course, if I divide this thing by 1,000. So this is what I should be getting as my closing stock. But why is my closing stock this? Hmm, this is because closing stock is, how will I use it now? Closing stock valuation is not based on actual costs of production. Closing stock valuation in this standard costing we're doing is based on standard cost. We said it when we are doing our budgeted cost. This is standard cost. So no matter how much you have made actually here, when you want to do your closing stock, you come down here and take your 10,200. So we take our 10,200, is 10,200 multiplied by 100 units. This is what we are getting. Of course, if I remove the three zeros by dividing by 1,000, I've removed the three zeros, I'm getting 1,020. That is what is done here. So if you look at it now, the actual closing stock of 100 units is measured at the standard cost of 10,200 per unit. This is what happens in standard costing system. So when we're using our variance analysis, we're using standard costing system. We're not using actual costing to measure our closing stock. Of course, you can use actual cost to measure our closing stock, but because we are in a standard costing system, that is what we use. Otherwise, your variance analysis will not balance. So this is one of the places where I want you to pay close attention. The closing inventory, always, always use the standard costing system to get your closing stock. Otherwise, when you are doing your reconciliation, it will not balance. So every other thing can be cost, actual cost, closing stock must be standard. Now, cost of sales, of course, this is your cost of sales, which is your total production cost minus closing stock. This is your cost of sales. This is your total production cost minus closing stock. This is your cost of sales. Then your profit is your sales minus your cost of sales. Same thing here. So this is 344. So this is your actual profit, and this is your budgeted profit. I can say this is your fixed budgeted profit. Fixed budgeted profit versus actual profit. All right, what does this tell us? Actual results differ from the budget. The company has not achieved its plan in January. The profit is less than the budget. Now, the company would like to understand the reason for this in details. So you see here, you've made a budget right from the time your sales unit is not even aligning. The budgeted is different from the actual, it didn't achieve it. The production too didn't achieve. Even the cost, even the selling price is even lower. Even the production cost is even lower. So the company has not achieved its purpose, its budget. This technique tells us that this technique explains the difference between, okay, sorry, the techniques that explains the difference between actual results and the budgeted result is called the variance analysis, which is the main thing we are doing here. So you see here, what we just did here is there is a budget of 48 and there's an actual of profit of 3466, 3446. Now, how did we get this difference? How can we reconcile this difference? So, if you want to know why these differences occur, you must do something called variance analysis. The sales figure is less than budget, yes, but why? The sales figure is a function of the quantity sold and the selling price. The quantity sold is less than the budgeted. But does price also have any impact? Yes, because there is a difference in price. Now we can see here that at first sight, it might look like the company has made savings on every cost line. By be looking at it that the company has made a savings, because look at it now. We said favorable budget is when the expected is bigger than the actual. Expected bigger than actual, expected bigger than actual. Look at sales here. If expected is bigger than actual, it means this is favorable, this is adverse. You might be looking at these two material you think is favorable, this is favorable, this is favorable, this is favorable. If all is favorable, why is your profit smaller? Then there's a problem. Now, at first, it might look as if the company is making a cost savings on every line. However, this is not a fair comparison. This is because you are comparing a budget of 1,200 units produced with 1,000 produced. It's not fair. It's just like comparing a primary one child with primary six. You are asking them to do a test and you are comparing them. Or you are comparing skills level with foundation level, or comparing a skills level student with a professional level student. It's unfair. So there must be a way so that you can compare them similarly. So you have to ensure that it is being converted in such a way that they can be compared to see whether there is actually a profit or not. So that's where we call a flexed budget. Now, variances are not calculated by comparing actual results to the fixed budget directly. Why? Because the figures relate to different level of activity, and it will not be fair to compare them with that. You can't be comparing production of 1,200 fixed budget with actual result of 1,000 units. Now that can you be comparing fixed budget sales of 1,000 units with 900 actual? And so what we do now is to draw up a second budget at the end of the period. So the first one is the fixed budget, which was done at the beginning of the period. This is what we use for planning purposes. The second one, which is done at the end of the period, is used for comparative purpose. This is what we now do to show our comparison if we really did well or not. Now, this second budget is called flexed. It is now based on the actual level of activity. So what it means is that 1,200 production that you have produced, that you budgeted before, you'll be asking yourself now, what if at the beginning of the budget we had planned to produce 1,000 and we have planned to sell 900? That's the actuals, right? What if we have planned that it was 1,000 we will produce and it was 900 we are going to sell? How will our second budget look like? So it means that you are now adjusting your original budget, which was done at the beginning, you are adjusting it to suit the actual level of activity. So now when we flexed it, look at what we get. It means that your sales is 900 units now at 15,000. This is budget now. Instead of 15 million, you're having 13.5 million. Now your cost will now be the same prices, but now 1,000 units. And of course, you have 10,200,000. Your closing inventory is still going to be at standard cost, which is this. Now you have cost of sales and your profit is now going to 4,320,000. Now you see here, it was 4,800,000 when it was fixed budget. You have now flexed it. So the only difference between the fixed and the flex is for sales unit, it changes to the actual sales that was made in the month. For production, it changes to the actual production done in the month. Of course, your cost of sales is the difference between your sales and the inventory and the production. So you see here, remember your closing inventory is a standard cost. Now your profit has now become this. So now it's now you can now compare 4,320 to 3,440, and you now ask yourself, what really happened? What really happened? This shows that the amount the company would have received for the actual number of units sold had they sold at the budgeted revenue per item is going to be this. So this is what profit we are supposed to make. But did we actually make the profit? Then there is a need to know what happened. So for you to understand variance analysis, you need to know this flexible budget. This flexed budget is also called flexible budget. A flexible budget is a budget that can be flexed. A fixed budget is the one that is rigid, the one made at the beginning before you start. Now, so look at it now. This is the sequence. This is the sequence. First, so this is the sequence now. Sequence. First, you made a fixed budget. So that's what happened at the beginning. The second, you get actual result. You get actual result. Then the third, you make a flexed budget to reflect the actual level of activity. Then after that, you do your variance. Variances. So you cannot just do your fixed budget and your actual, you now do variance. No, they will never be the same, except if the actuals are the same level of activity with the fixed. Then there will be no need to flex because the fixed, the actuals conform with the level of activity with the fixed. But if they don't conform, you must flex. Then it is now going to be variances based on actual and the flexed. All right. So that's it. So now let's look at comparison. Now, if you look at the comparison now, all these three statements can be compared now. Look at the fixed budget, look at the flexed, and look at the actual. Of course, this is the fixed budget that is made first. Actual is what happens next, but look at the actual is usually last. So you fixed, you flexed it. So how do you know it is flexed? This is the original and original. Flexed, it means these two are the same and these two are the same. So sales unit, production unit will be the same for flex and actual. That means it has been flexed. Now, if you look at it now, if you compare it now, your sales position, you budgeted to make 3,500 and you are making 13,500 and you sold 12,600. You find out that it is adverse, and you know this is not based on quantity or volume. You know this is price variance because your price here was 14,000. We know that, and this was 15,000. If you had sold 15,000, it would have been this. Now look at your cost. This is 5,000. So you're not looking at this anymore. But you know this is from this you got this. From fixed you got flex. Now you're looking at it now. If you look at it, expected. So, but this is budget now, but you can see actual. This is what they mean. This flex budget is based on actual level of activity. That is what it means. So sometimes you'll be hearing things like standard cost for actual level of activity, standard hours for actual level of activity. When you hear me say that, it means I am referring to the flexed budget. All right, so this is what you are expected to sell, and you made you sold. Sorry, this is at what you expected to say. You sell less, so this is adverse for you already. Adverse, but the cost now. This material is favorable, right? Labor seem to be adverse. Why? Why is the material favorable? You need to investigate. Why is the labor adverse? You need to investigate. Look at now variable overhead. You see the actual it seems to be adverse. So if you have been comparing it to this fixed, you'll be thinking everything is favorable. But yeah, you see this is adverse. This fixed overhead is also adverse. It's also adverse. So you see, at the end, you have more adverse than favorable, so your profit goes down. All right. This information for Lagos manufacturing performance in Lagos will be used throughout this our example. So this will help you to truly and thoroughly understand variance analysis, so that when you pick any question, this concept will help you. Now look at the commentary here. Variance analysis explains the difference between the fixed budget profit and the actual profit. So when we are saying in variance analysis, we are trying to find the difference between these two profits. Never these two, not this. This is the difference. This is what we planned to make. This is what we made. Now, why this difference? For us to know why this difference, we need to now make a second budget. So these are the flex budget that will give us the reasons for the difference. So it means that even though you have produced a flexed budget, your variance analysis is going to reconcile fixed budget profit fixed budget profit with actual profit. Because why? This is what you set out to produce, or the profit you set out to make. You want to know why you didn't make it. Okay, so both the fixed okay, they say this paragraph provide an initial comment before looking at the detailed calculation which will be discussed in our lecture 2 on this topic. So both the fixed budget and the flexed budget are based on what? Standard revenue per unit, standard cost per unit. So you see, our budget is being done using standards per unit. And I said standard is for 1 unit, budgeted is just use your standard multiplied by your level of activity. So for the fixed budget, production with 1,002, flex budget is just 1,000. Therefore, the difference between the fixed budget and the flexed budget is just caused by difference in volume. It is just caused by difference in volume. So this 480,000 and this 4,800,000, and okay, let's look at it now. Let's see what they are saying. 4,800,000. This is what is the profit for the fixed. minus 4,320,000 is 480. This is caused by volume. It is caused by volume, and that is called volume variance, which we will discuss later. If you look at it now, it is how many did you sell? You sold 1,000 and you sold 900 as against 1,000. So if you are to just, this is not just going to divide this thing by 900 or dividing it by 1,000. No. So this this 480,000 we have here is what we call sales volume variance. Sales volume variance. That is the difference why we have these two here. That's the only difference. So every other thing now is in line with this. So when we are doing our variance, even though this is our helper, this is our helper column, this is our helper column, which will assist us in the variance, we are actually going to compare actual and fixed. And we will also take note of this volume variance. So this volume variance is important, such that after we have compared flex and actual, flex and actual, flex and actual, remember we need to still bring this volume variance. That's the only link that is going to help us now to make it back to fixed budget. We'll talk about it later. Now, revenue is sales quantity times sales price, and the revenue is the fixed budget, and the revenue of the and the actual revenue are based on, sorry, flex budget is based on quantity sold. Therefore, the difference between the two figures is 900,000. 900,000. So if you look at this now, both of them are based on actual sold. So the difference between these two is 900,000. That's what they said, 900,000. This is due to difference in selling price per unit. This is also called sales price variance. We'll talk about it when we are doing sales variance. So we have just given you sales volume variance, also giving sales price variance. Okay? So sales volume variance, you are looking at flexed, and you're looking at budget and flexed. You get your sales price variance here, volume variance, sorry, sales volume variance. Then when you now look at sales price variance, you're now looking at actual here, flexed and actual, because they are based on actual quantity sold. That means the price. So if you look at it, the price, if there is difference, it's because of price, because it is the same 900 that was sold. But if you look at this here, they are the same prices. They are the same prices giving you this figure, the same profits, they are the same. Every indices that was used here is the same price that was used there. So the difference that you have here is based on volume. The same thing, the difference you have here is based on volume. This is what we call sales volume variance. We'll talk about it later. Now, the difference between each variable cost line in the flexed budget and the equivalent figure in the actual column is called a total cost variance for that item. So what it means here is when we are doing our variance, we'll be comparing this with this. So if there's a difference in material, this is a total material variance. This is the difference here is called total material variance. Now, this doesn't tell us whether the variance came as a result of quantity or price, whether it is usage or price. This is just the total, but we need to analyze it. Is this variance caused by price or is it caused by usage? We need to find out. All right. So we say here, for example, the result shows that 1,000 units use 4,004,608. Okay, 1,000 units of sale of production. This is the material we use. All right. The flexed budget shows that this should have cost you 5 million, but we spent 4, but material cost us here 4,004,608. So why? The difference of 392 is due to the combination of actual material being used to the budgeted usage and the actual price. So that's why I said it's based on either price or usage variance, which we will discuss later in part 2. So the same thing applies to um, labor, and the same thing applies to variable overhead. So we said variable overhead. There's a different way of handling fixed overhead. So now you see here, the variance cost, variable cost variance, variable cost variance, variable cost variance. When I say variable cost variance, I mean direct material, direct labor, and variable overhead. So variable costs is different from variable overhead. Just take note. Variable cost variance can be calculated for all items of variable cost. The method of calculating the variances is similar for each variable cost item. And I'm going to teach you how you can derive the formula by yourself and apply it on direct material, on direct labor, and variable overhead with ease. So you don't need to cram the formula. So the total cost variable for the variable cost is the difference between the actual and the standard. However, the total cost is not usually calculated. The total cost is not usually, the total cost variance is not usually calculated. What we do is we break them in parts. We break them in parts and we get the individual parts. So what we do is, instead of calculating total material cost variance, we want to do material pricing variance and material usage variance. Then we now add them together to get the total. All right, so we are going to be ending the part 1 here, so that, okay, so we will look at, let's talk briefly about this cost variance before we end it. So we said this is talking about adverse and favorable, and we said actual cost, when actual cost is higher than the standard, the cost is adverse. Like as I said, if actual is higher than expected or expected is lower, sorry, when actual is higher than expected or expected is lower than actual, then it is adverse. But when actual is lower than expected, then it's favorable. It's the same thing, and it relates to all the variances. All right. Now, in a costing system, in a costing accounting system, cost variances are adjustments to the profit in an accounting period. So cost variances, they usually are adjustments to the profit. So what happens is that because we are calculating the variances from the fixed budget, we want to explain the difference between the fixed budget profit with the actual profit. When I say the fixed budget profit, it's not the flexed, it's the fixed. We are going to be adjusting. So we'll start with the fixed budget cost, which is that 4.8. And we'll now say, okay, let us adjust it with these variances. All the favorable variances is supposed to increase the profit being reported. Okay, so we could even start with the actual, we even start with the actual, we could even start with the actual profit you made, actual profit you made. So all the favorable variances are supposed to increase your profit, and all the variances that are adverse are supposed to reduce your profit. And when you do that adjustment, you have your reconciliation. So the method of calculating cost variance is the same. All right. So now look at variances and performance reports. Variance reports are produced at the end of each month or each control period. So it means that you have a control, your control report. So you have your fixed budget, and you have your actual, and you have done your flex. You want to now do your variance report. You now say large adverse variances indicate poor performance. We said that before, and need control action by management. Large favorable variances indicate unexpected good performances, and management may wish to consider how these good performances will be maintained. Variances might be reported in a statement for the accounting period that reconciles the budgeted profit, that the original profit, with the actual profit for the period. And that is what we call the operating statement. This statement is called the operating statement. Sometimes they will call it reconciliation statement. So sometimes if they give you your variance, you might be asked, you might be given, um, a question can come and they give you, it could be a question number one question. They might give you the standards, and they will give you the budgeted quantity and budgeted sales. Then they will now give you the actual results. And the question will be, question number one, prepare the, the original fixed budget. That's 1A. Number two, prepare the um prepare the actual result in a statement. Part C could be prepare a flexed budget, and part D could be prepare the reconciliation statement or the operating statement. So for you to prepare that, you would have done your variances and use it to prepare it. So that is where our part one is going to end for today. We are going to take part two in our next class, where we'll be looking at all the variances, the the cost variances and the sales variance. That's where we are going to end. Then part three, we'll be looking at advanced variance. So you see now, what we have actually learned today, we have learned two things. We've learned what standard costing is, and we have prepared a standard cost card. Use the standard cost card to prepare our fixed budget. The next thing we've learned is that we have learned how to prepare a flexed budget. And we know that a flexed budget comes at the end of the period after we have seen the actuals and we know the level of activity used for the actual. We now prepare a flexed budget. Then we also learned that we are going to reconcile the fixed budget profit with the actual profit. And we're going to use the helper column, our flexed budget, to do this reconciliation. Next week or next class, we are going to see how this reconciliation is done after learning the variances. So thank you so much for today, and please uh, make sure you review what we have learned today so that you can brace yourself up for the next class, because it's going to be more interesting than this. It's going to be more interesting if you don't know this standard costing. It's going to also have a little disturbance in your knowledge of variance analysis. So once again, thank you so much and do have a wonderful night.